Thousands of tractors blocked the streets of London. 13,000 farmers descended on Parliament in what would become one of the largest rural protests in modern British history. They didn't organize these massive demonstrations because they wanted to protect billionaires trying to dodge taxes or shield wealthy landowners from paying their fair share. They organized because, starting in April 2026, a new tax rule could force them to sell their family farms just to pay inheritance taxes they couldn't afford. And what makes this even more complicated and infuriating to the farming community is that the government's original plan would have destroyed more farms than most people realize. This is the story of the tractor tax, and why it matters far more than the name suggests, and why understanding it matters for food security, rural communities, and the future of family farming in Britain. In October 2024, the UK government made an announcement that would shake the countryside to its core. After winning the general election, the newly elected Labour government, led by Prime Minister Keir Starmer, decided to remove a tax exemption that had protected family farms for over 3 decades. Since 1992, the intergenerational transfer of farms had been completely exempt from inheritance tax. This exemption was put in place for one specific reason: to protect food security. The government at the time understood that farming was different from other businesses. When you inherit a factory, you might sell it and pay the taxes from the proceeds. But you can't do that with a farm. Farmland is your business. It's where your income comes from. You can't harvest profits and separate them from the land itself. So the government's new plan changed everything. Farms valued at over £1 million would now be subject to inheritance tax for the first time in 32 years. That means when a farmer died and passed their farm to their children, the family would have to pay a 20% tax on any assets above £1 million. This wasn't positioned as a tax on the wealthy. It was framed as a way to raise revenue for public services and to make the tax system fairer by closing what the government saw as an unfair loophole. But farmers saw it completely differently. The reaction was almost instantaneous. Within weeks, thousands of farmers began organizing. By November 2024, the protests reached their peak. 13,000 people gathered in Parliament Square with tractors, signs, and a message that the government wasn't hearing them. One farmer, Gareth Wynne Jones, stood in front of rows of stationary tractors and told the media, "It's the final nail in our agricultural coffin." Other protesters held signs reading, "No farmers, no food, no future," and "We can't afford to feed you anymore." These weren't just emotional statements. They represented genuine fear about what this tax would actually do to family farming in Britain. The biggest surprise to many people was who was protesting. When you hear about tax protests, you might imagine wealthy business people trying to protect their fortunes. But farmers aren't typically wealthy in the way we think of wealthy people. Yes, they own valuable land. A 200-acre farm in the English countryside can easily be worth £3 or £4 million. But that doesn't mean the farmer who owns it is rich. That doesn't mean they have the cash to pay taxes on that value. In fact, it's the exact opposite situation. This is where we need to understand the fundamental problem that nobody in government seemed to grasp until thousands of tractors showed up at their doors. Farmers are asset rich, but cash poor. This phrase captures the entire paradox of agricultural economics. A farmer might own £5 million worth of land and equipment, with all the machinery, buildings, and infrastructure necessary to run a successful operation. But they might only make £50,000 a year in actual profit after paying all expenses. Their wealth exists on paper in the form of physical assets that are essential to producing food. It doesn't exist in their bank account or in liquid savings they can access. You can't spend land. You can't use equipment to pay bills unless you sell it, which means destroying your capacity to produce anything. And if you sell your farm to pay inheritance taxes on assets you must keep to remain operational, you're no longer a farmer. You've destroyed the family business that's been operating for generations and contributing to your community. Consider what a typical family farm looks like financially to really grasp the scale of this problem. A mid-sized farm generating £150,000 in annual revenue might have operating costs of £120,000. Costs for feed, fuel, machinery maintenance, labor, property taxes, insurance, and all the other expenses necessary to run an agricultural operation. That leaves the farmer with £30,000 in actual income to live on, reinvest in equipment, and save for emergencies. But that same farm sits on land worth £2 million, with tractors, equipment, buildings, and infrastructure worth another £1 million. So on paper, the farmer is worth £3 million. But in reality, they're taking home £30,000 a year to support themselves and their family. Now imagine that farmer is 65 years old and ready to retire after a lifetime of work. They want to pass the farm to their son, who's been working there for pounds come from? The son doesn't have it sitting in savings. The farm doesn't generate enough profit to cover it in a reasonable time frame. The only option is to sell land or equipment. And once you start selling parts of a family farm to pay taxes, you're no longer running a viable farming operation that can sustain the next generation. This situation isn't rare. In fact, research conducted by farming organizations showed that more than 75% of farms in England and Scotland would be affected by the original tax proposal. This wasn't a tax on billionaires. This was a tax that would touch the majority of family farms across the entire country. When the government said the tax would only affect wealthy estates, they simply didn't understand farming. They were thinking like urban policymakers looking at numbers on a spreadsheet, not like people who actually grow food for a living. The economic pressure on farms had already become severe long before the tax announcement. Farmers explained that their incomes had been squeezed over years by multiple forces. British supermarkets have enormous purchasing power and use it to drive down the prices they pay farmers. Cheap imports from abroad undercut domestic production. Subsidy cuts following Brexit had removed income that farmers depended on. Input costs, from fuel to fertilizer to animal feed, had skyrocketed. A survey conducted by the CBI Economics on behalf of Family Business UK found that nearly a quarter of family businesses and 17% of family farms were already cutting jobs or pausing recruitment due to economic stress. Some were even threatening to close entirely. Then the government announced the tractor tax, and it felt to farmers like an attack on an industry that was already dying. The protests grew larger and more organized. In mid-November, the main rally at Parliament drew over 13,000 people. What shocked many observers was the diversity of the movement. It wasn't just traditional farmers. It included rural business owners, landowners, agricultural workers, and supporters who understood what was at stake. Jeremy Clarkson, the television personality and farmer who runs Clarkson's Farm, was there. His presence drew significant media attention and amplified the message beyond farming communities. This was mainstream rural Britain saying the government had made a terrible mistake. But the government doubled down. When farmers complained, government officials responded by saying that only the richest estates would be affected. Environment Secretary Steve Reed told the media that the vast majority of farmers will not be affected at all, and blamed misleading headlines for the backlash. He claimed only the richest estates would face higher taxes. This response demonstrated a fundamental disconnect between government policymakers and the farming community. The government was looking at land values and thinking anyone with a £1 million asset must be wealthy. Farmers were looking at their profit margins and knowing they couldn't survive this tax. The protests didn't stop. In fact, they escalated. In February 2025, Save British Farming organized a second massive rally that drew over 1,000 tractors to Westminster. The message was becoming clearer with each demonstration. This wasn't about protecting billionaires. This was about protecting food production. One protesting farmer, Ollie Harrison, articulated the core argument perfectly when he said, This distinction is crucial. Land value and farming income are completely different things. You can't eat land value. You can't pay workers with it. You can't buy seeds or fuel or pay your mortgage with paper wealth. The tax was treating farming wealth like investment wealth, but farming isn't an investment. It's a profession, a way of life, and the foundation of food security. When you tax the transition of farming from one generation to the next based on asset value rather than income, you're essentially forcing family farms to liquidate to survive. The fears weren't theoretical. Farming organizations warned that forced asset sales would be the inevitable consequence. If a farmer's children inherited a farm worth £2 million and had to pay $400,000 in taxes, they would need to sell part of the farm. Maybe they sell 200 acres to pay the taxes. That's a 15% reduction in farm size. But it's not just a reduction in assets. It's a reduction in production capacity, in income potential, and in viability. A farm that was barely profitable at full size might not be profitable at 85% size. Over time, as multiple generations faced this tax, family farms would keep getting smaller and smaller until they reached a point where they no longer functioned as businesses. Large agricultural corporations, by contrast, could absorb these costs. They could leverage their profits across multiple operations. They could access capital markets. They could structure their holdings in ways that minimized tax exposure. The tractor tax, despite being framed as making the system fairer, would actually accelerate the consolidation of farming into fewer and larger corporate operations. Small family farms would disappear, replaced by industrial-scale agriculture owned by distant corporations. This wasn't what government policymakers were explicitly trying to achieve, but it was the inevitable consequence of their policy. The farming community also raised important concerns about food security that extended beyond just their own economic interests. Britain had become increasingly dependent on imported food over the past couple of decades, with domestic production declining as a proportion of national food consumption. The government's own stated goal, outlined in various agricultural policy documents, was to increase domestic food production and reduce dependence on imports. But you can't increase domestic food production by destroying family farms through taxation. You can't maintain food security by forcing the next generation of farmers to sell their land to pay taxes on assets they need to operate. The irony was profound and hard to ignore. The government was trying to balance the budget by taxing farms. But in doing so, they were directly undermining the very thing they claimed to want to protect through other policies: Britain's ability to feed itself and maintain agricultural independence. Then something interesting happened. As the protests continued and the evidence mounted, the government began to listen. Not because they wanted to, but because the political cost of proceeding was becoming impossible to bear. Farmers weren't complaining quietly. They were blocking roads, surrounding Parliament, and generating massive amounts of media coverage. The message was getting through to ordinary people who might not care about farming, but who understood food security and family businesses. After more than a year of sustained pressure, the government finally announced a significant change to their plan. On December 23, 2025, the Chancellor announced that the inheritance tax threshold for agricultural assets would be raised from £1 million to £2 million, 500,000. This more than doubled the original figure. Additionally, for married couples or civil partners, the threshold could reach £5 million combined. Suddenly, far fewer farms would face the tax at all. The government estimated that these changes would reduce the number of estates affected by roughly 50%, from 375 down to 185. They projected that around 85% of estates claiming agricultural property relief would not face higher inheritance tax bills as a result of the changes. For many farming families, this was a substantial relief. National Farmers Union President Tom Bradshaw responded by saying the increased threshold would come as a huge relief to many farming families. He acknowledged that while the policy still existed, the farming community had achieved real mitigation of its worst impacts, but the new threshold still leaves significant challenges. Even at £2 million, 500,000, there are farms above this level that will still face taxes, and the tax burden on those farms remains steep. Above the threshold, 50% relief applies to qualifying assets, meaning an effective inheritance tax rate of 20% instead of the standard 40%. The tax can be paid in installments over 10 years interest-free, which helps with cash flow, but it still requires long-term financial commitments that farming operations might struggle to meet. The compromise also reveals something important about who is actually affected. The farms that fall between £1 million and £2 million, 500,000 pounds, are typically not massive corporate operations. They're mid-sized family farms. Farms that have grown over time through good management and smart decisions, but remain fundamentally family operations. These are the farms that might have one primary house, a few farm buildings, 50 to 200 acres of land, and equipment worth several £100,000. They're economically viable. They're productive. They're important to their local communities. But under the new rules, when the owner retires and passes the farm to the next generation, there will be a significant tax bill. The whole situation illustrates a broader problem with how governments approach taxation of assets versus income. Farming is an unusual business because so much of its value is tied up in physical assets that are also the means of production. You can't separate the land from the farming business. You can't take the value out of the land and leave the farming to continue. This is fundamentally different from, say, taxing the inheritance of a stock portfolio or a commercial building. Those assets can be sold and the proceeds distributed without destroying the underlying business. But with a farm, selling assets to pay taxes destroys the business itself. The government's original approach treated all inherited wealth the same way. But farming requires different treatment because farming is different. It's not an investment strategy. It's not a wealth accumulation mechanism that wealthy people use to pass money to their children. It's a profession, an occupation, a way of producing food. When you tax it like an investment, you destroy the profession. The farming community tried to explain this to the government for years, but nobody listened until thousands of tractors showed up. Now, as we move into 2026, the new rules are taking effect in April. Most farms will not be affected by the inheritance tax changes, but some still will be. The question for those farms is how to plan for the future. Some farmers are considering lifetime gifts to their children to reduce the taxable estate. Others are looking at reorganizing their operations into partnerships with multiple family members to split assets and take advantage of multiple thresholds. Some are considering whether to marry long-term partners to double their inheritance tax allowance. These are the strategies people turn to when government policy forces them into uncomfortable positions. The legacy of the tractor tax debate extends beyond the specific tax rule. It demonstrated the power of sustained, organized protest. When thousands of farmers descended on Parliament, they changed government policy. When they explained their situation clearly and repeatedly, people listened and understood. The compromise that emerged wasn't perfect for everyone, but it was substantially better than the original plan would have been. It also highlighted the gap between policymakers in London and the realities of rural life. Government officials making decisions about agricultural taxation often have limited direct experience with how farms actually work. They see numbers on spreadsheets and make decisions based on abstract principles of tax fairness without considering how those principles play out in practice. This gap between policy and reality is dangerous because it leads to policies that sound good in theory but cause real harm in practice. The tractor tax was an example of that disconnect. The debate also raised questions about what kind of agricultural future Britain wants. Do we want to maintain a diverse landscape of family farms, each running their own operations and contributing to their communities? Or are we willing to accept the gradual consolidation of agriculture into fewer, larger corporate-owned operations? These are the choices that tax policy forces us to make, whether we intend to or not. Every policy has consequences that extend far beyond the immediate financial impact. For the farming community, the tractor tax was a wake-up call about the need for better communication between rural and urban Britain. Farmers felt that urban policymakers didn't understand their lives, their businesses, or their challenges. And in many ways, that was true. But the protests also showed that when farmers organized and made their case clear, ordinary people in cities could understand and sympathize. The issue wasn't that people didn't care about farming. It was that they didn't understand the challenges farmers faced until someone explained them clearly. Looking forward, British farms face a complex future. Climate change is creating new challenges. Competition from imported food continues to put pressure on domestic producers. Labor costs are rising. Input costs remain high. The industry is struggling to attract young people to farming because the financial returns are often insufficient to justify the hard work and risk. Into this already difficult environment, the government was proposing a tax that would have made everything worse. The tractor tax represented a fundamental misunderstanding of how to support food production in rural communities. The government's U-turn on the tax threshold was significant, but it wasn't a complete surrender. The tax itself remains. The government still believes that large estates should pay some inheritance tax. The question is, how large? By raising the threshold to £2,500,000, the government found a middle ground that affects fewer farms while still maintaining some additional revenue for public services. Whether this is the right balance is debatable. Some argue it's still too high a threshold and too lenient on wealthy agricultural landowners. Others argue that even the new threshold will still force too many family farms into difficult circumstances. What's clear is that the debate changed how people think about agricultural taxation. It's no longer acceptable to treat farm inheritance like any other inheritance. Agricultural policymakers now understand that the financial structure of farming is fundamentally different from other businesses. Land and equipment are not separable from the farming business in the way that other assets might be. The value on the balance sheet doesn't translate to cash that can easily be used to pay taxes. Future tax policy must account for these realities. The tractor tax also demonstrated the importance of understanding the difference between wealth and income. Someone can be asset rich but cash poor. They can own millions of pounds worth of property while making a modest income. This situation is common not just in farming but across multiple industries and professions. Teachers and nurses in expensive housing markets face similar situations. Small business owners often have significant assets but uncertain income. Any tax system that ignores this distinction will inevitably create situations where people must liquidate productive assets to pay taxes on wealth they don't actually possess in liquid form. The farmers who protested weren't trying to avoid paying taxes on profits they made. They were arguing that you shouldn't have to pay taxes on asset transfers when you're not generating the income to support those taxes. This is a reasonable position. If a farmer makes £30,000 a year and inherits a farm worth £3 million, it doesn't make sense to demand a tax payment in the hundreds of thousands from someone whose annual income is only £30,000. That person isn't wealthy in any meaningful sense. They're just someone inheriting a business. As we move through 2026 and beyond, the farming community will watch carefully to see how the new rules play out in practice. Some predictions suggest that relatively few farms will actually face inheritance taxes under the new thresholds, but uncertainty remains for those farms that fall in the middle ranges. They'll need to plan carefully and possibly restructure their operations to minimize tax exposure. They'll need to consider when to retire and how to transition their operations to the next generation. The tractor tax also raised a broader question about government engagement with rural communities. Farmers felt that nobody in government actually listened to them until they made so much noise that the government had to pay attention. This suggests a systemic problem in how government develops policy for sectors it doesn't fully understand. Better consultation, more direct engagement with people in the industry, and a genuine effort to understand how policies will affect actual operations might prevent situations like this in the future. For young people considering agriculture as a career, the tractor tax controversy adds another substantial layer of concern and uncertainty. Inheriting a family farm already involves significant uncertainty and risk. You're depending on commodity prices that fluctuate in global markets, weather conditions that you can't predict or control, government policy that changes with each election, and market conditions that can shift dramatically. The prospect of also facing significant inheritance taxes when you take over the operation makes the situation even more financially precarious and harder to justify. It's one more reason young people might choose a different career path towards something more stable and predictable. This has serious long-term implications for food security, rural employment, and the character and sustainability of rural communities across Britain. The government's original position that only the richest estates would be affected has been thoroughly discredited. The evidence shows that mid-sized family farms would have been heavily impacted. This should give policymakers pause about their assumptions regarding different industries and professions. When you don't fully understand how an industry works, you're likely to make mistakes. The farming community's response was to educate the government through sustained protest and clear communication. That education worked, leading to significant policy changes.